Our market monitor tonight says it's hard to find value in the stock market right now, but he's still finding some gems. He's Patrick Kaser, portfolio manager at Brandywine Global. Patrick, welcome. Good to have you with us. You just heard Dominic's report. He says, pointed out that a lot of the smaller stocks have rolled over. Do you think they represent the better values or the big guys?
No, I think the large cap stocks, which my team at Brandywine works on the most, I think the large cap stocks are still the best place to find value in the market. A lot of the small cap stocks have gone from kind of tremendously overvalued to just slightly overvalued, perhaps. So we still think that many of the bigger, higher quality companies offer the most attractive returns going forward.
You have a couple of stocks you want to give as examples, and it seems like the running theme is that you're really looking for the bargains. And at the top of your list is Toyota, and you say that this is one of the cheapest stocks in the world. Make your case.
Yeah, absolutely. So Toyota today is about $108, $109. One of the interesting things, it has $40 of cash, net cash on the balance sheet. So you're really only paying $68 or $69 for the actual business. Earnings for the last 12 months are $11.50, $12, depending on how you treat some of the charges. So you're really paying 5.5, 6 times on earnings. So a very, very low PE relative to a market PE that's more than twice that. It's the #1 auto company in the world, tremendous balance sheet, very conservative management. As we look forward with the cash there, in a year or so, we think they're going to start buying back stocks. We think you can make 50% or more easily in this if you're a long-term investor over 2 or 3 years.
You've got a $70 a share price target on Citi. How soon could it get there? And this is a stock that, to me, feels like a very, very risky choice.
Yeah, well, so it's obviously a stock that's been in the headlines, but a lot of times the best opportunities for investor are the things that nobody likes or things that people aren't going to work. So with Citigroup, obviously it's been in the headlines for the Mexican fraud, for failing the stress test, but we think they can earn $7 in a couple of years. We think that at $46, $47 a share, you're paying less than 7 times future earnings power. The other thing is, you think about risk, Citigroup is the only major bank trading below tangible book value, so tremendously cheap relative to other banks and, again, to the market.
Let's talk a little bit about Metlife. This is a stock at $51 that's pretty much trading today at where it was in January, so it's been kind of flat for the year. What's your target on this stock, and why should investors put some fresh money into MET?
Yeah, again, so the 3 I mentioned today, we all think they have maybe 50% upside over the next 12 to 18 months, perhaps. Met, again, much cheaper than the market. Again, some controversy around it. It's got a lot of excess capital, a lot of extra funds. It hasn't been buying back stock because it's waiting to see what rules the Federal Reserve puts out there for insurers. But in the meantime, it's trading right around book value again, so we think not a lot of downside. It's trading at less than 10 times earnings, PE of less than 10. Again, very cheap relative to the market. We think that once there's some certainty out of Washington, that they will begin buying back stock, and it will be a tremendous opportunity for investors. So all 3 of these stocks, again, very cheap, some controversy, but that's really where I think value investors and investors that have a longer time frame in general can find the opportunities.
You want to exploit those headlines, don't you, Patrick?
We absolutely do. That's one of the things we do here at Brandywine, is to try and move against the grain but stay high quality and in names that people know.
Takes some steely nerves to do that. I know you're a sort of a bottoms-up stock picker, or I sense that, but you must have some view on economic growth and interest rates. Would you share it with us?
Right. Yeah, absolutely. I mean, when you're buying big companies, the single biggest determinant of their results is the economy. So we absolutely do have macroeconomic views, and those drive how much conviction we have in our research. So when we look at the economy and we look at the interest rates, especially for the 2 financials, we think long-term interest rates, particularly long-term interest rates, rise. That's very good for Citi and Metlife. But more importantly, we think the economy is going to grow at a moderate pace. There's been a lot of debate over the last few months. Was it a winter slowdown? Is right now just a temporary bounce? But right before I came on the air, I saw that the Federal Reserve loan data, it appears that commercial and industrial loans are still accelerating. Commercial real estate loans are still accelerating. We believe the economy is gaining momentum. And so while we've had this debate in the market where we've been a choppy period, sideways overall, we do think that resolves itself. We don't think this is one of those years where it's sell in May and go away. We think this is a year where, as people become convinced that the economy really is doing well and picking up speed, that the market will have a much better second half of the year.
Patrick, do you have any disclosures on those 3 stocks, Toyota, Citi, and Met?
Yeah, you know, we, as a firm, we own shares in all of them because I invest in Brandywine's products. I own shares personally on all of them, but Brandywine does not have any banking relationships.
All right, Patrick, thank you so much for being with us. Patrick Kaser with Brandywine Global.